Welcome to the second module of our course, where we explore one of the most common funding avenues for African SMEs, loans. In this session, we'll walk through what loans are, why they matter, and how to access them wisely. Let's begin with the basics. A loan is borrowed money, also known as debt capital, that a business agrees to repay over time, typically with interest. Loans generally fall into two categories: secured loans, which are backed by collateral like land or equipment, and unsecured loans, which are based on credit history, group guarantees, or alternative data like mobile money transactions. For many African businesses, loans are a critical financial tool. They help smooth out cash flow, especially during seasonal cycles. They allow you to invest in equipment and technology without depleting your savings. And they offer the flexibility to expand operations or meet large orders by covering inventory or production costs in advance. Now, where do SMEs in Africa usually turn for loans? Commercial banks are a key source, offering traditional SME loan products, usually with interest rates ranging from 15% to 25% annually. But access to these banks often requires formal registration, tax documentation, and strong collateral. That's where microfinance institutions, or MFIs, come in. They provide smaller loans, typically between $100 and $10,000, and are often more flexible with collateral requirements. Think of institutions like LAPO in Nigeria or Kenya Women Microfinance Bank. They cater especially to micro and small businesses, with interest rates ranging from 20% to 35%. Then we have SACCOs, Savings and Credit Cooperative Organizations. These are member-driven and offer lower rates, generally between 10% and 20%. SACCOs require members to contribute savings and often use that as the basis for loan approval. And finally, digital lenders and fintech platforms like Fairmoney or Branch are changing the game. These platforms use mobile transaction data to offer quick, collateral-free loans. The downside? Higher interest rates, sometimes ranging from 30% to 60% per year. But for many SMEs, the speed and ease make it worthwhile. Bank loans are most suitable for formal SMEs with strong documentation and solid collateral. They offer lower interest rates and longer repayment periods, but come with strict approval processes and heavy paperwork. On the other hand, MFIs and SACCOs are more accessible for smaller or early-stage businesses. They're quicker, more flexible, and grounded in community support. But the trade-off is smaller loan sizes and shorter repayment terms. Whichever lender you choose, it's important to follow a structured loan application process. First, assess how much you really need. Include a buffer for unexpected costs. Next, choose a lender that aligns with your business profile and timing needs. Then, gather your documentation, your business plan, financial statements, any collateral records, and your mobile money history if you're applying to a digital lender. Submit your application with care. Complete every field. Follow up respectfully and stay organized. If you're approved, review the terms closely. Negotiate if necessary, especially around collateral and fees. Finally, have a system in place to manage your repayment schedule. Late payments damage credit and jeopardize future funding. Avoid common mistakes like submitting incomplete business plans, setting unrealistic repayment projections, or overlooking local fees and legal obligations. Instead, focus on transparency, preparation, and data. Keep accurate financial records, track your daily sales and expenses, and ask for guidance from trusted advisors or local business groups. When used strategically, loans can unlock the next phase of your business. But it all starts with understanding your options, choosing the right partner, and managing the process with care.